it was really interesting because I've read this book about 3 times in the past, but when you read it to try and prepare some unique material for people, it forces you to really read between the lines and find some little gems. So hopefully it'll give you a chance to look at the charts and indicators in different ways and build confidence in the things that you see and really feel like you've arrived. You know, that's really how I feel like when I'm trading successfully. I see myself already there, and you need to be there too. And that means really doing the work for yourself. So the things that I present today, you need to see, where does it work? Where doesn't it work? Does this work for me? Is there an idea I can extract from this? So that's my goal today. It was funny because I tweeted this earlier, just to the link for people. And I've known Stanley Dash for a number of years, and this is what he tweeted me back. I had the privilege of working with Arthur at E.F. Hutton for many years and was his desk buddy. This was in the 1970s. A meticulous and thoughtful and generous man. He started in the business as a coffee taster here in Lower Manhattan, and apparently he threw himself into the charts 24/7, 7 days a week. And so his book shows a wealth of interesting and unusual techniques. But I'm really here just to talk about one of them, as well as his main words of pearly wisdom. And this to me is my philosophy, all summed up in this one sentence. A chartist's asset lies not so much in being able to forecast how high or how low a market will go, or when it will get there, as in being able to identify the direction of a trend and to call the turn of the trend when it comes. So all my work and my research that I've done for going on 40 years now has come to the same conclusion. I cannot, with any statistical significance, say how high a market's going to go or how low a market's going to go, or for how long it's going to go. However, there are very strong signs of clues that identify when there's going to be an impending change of direction. Okay, not all the time, but lots of times. And then once you have an established trend. So that's far more important to me than trying to, you know, call tops or bottoms and so forth, you know, at price levels. Another interesting thing that I thought was that I hadn't picked up in the previous times that I read the book was how he sees everything in terms of zigzag patterns. And this also is where the bulk of my research has been 10 years ago. I don't know how many of you have seen my previous presentations on market structure and the red, green, red rule, and identify the swings by average true range functions. Okay, and so this really is close to the zigzag patterns that we'd see from the swing trading charts from people like Gann and Wyckoff when they used to do the just simply connecting the swing highs and swing lows. So he saw all chart formations, and I'll give you some examples in terms of this zigzag, which is exactly what I do. And then also everything is about putting something in context. Extremely important with the momentum work I'm going to then show you next. Everything is about putting things in context, which is why humans can have an edge over computers at times. It's very difficult for computers to put certain things in context. We start adding filters and data mining and so forth, and you start to lose a little bit of the robustness of the work. So everything he sees is minor zigzags, major zigzags, so forth and so forth. And then if we look here, this is exactly what I'm talking about. The S&P daily, weekly. So I'll always use 2 time frames within my contexts. And, you know, this is not a perfect ABC, ABC, ABC type of rhythm, but still it's that feeling of zigzags, even if they're not perfect ABCs. You know, for example, in the middle of this chart here, having this ABC zigzag, bigger ABC down, if you will. You get the idea pretty quickly. This is gold, a daily and an intraday chart, 240-minute. I actually made this chart last week, And I was thinking, you know, we still have pretty good odds of retesting that previous swing low on the daily charts. And that's actually what we did. We had a third push down on that 240 minute before doing that test and reject area. So all the time when I'm looking at these zigzag patterns or swing highs or swing lows, I'm always watching price relative to that previous swing high. And I don't know in advance if we're going to make a higher low or just a test or a much lower low or an equal length swing down type of thing. But it's really important when you're doing your own trading, watching price relative to another pivot point or level. And is it going closer? Is it, you know, moving further away? So just lastly, I put one more chart here of monthly, weekly. So I love the monthly charts for the currencies and the weekly charts for the currencies. As an aside, the higher time frame that you go out for your analysis and your actual trading, the less noise you will get. So techniques like this can get very noisy and choppy on 5-minute data, even though you will see spots, of course, that does work. But you know, again, that context of the ABC up or another zigzag up, zigzag down, use your imagination and see if any of that works for you. It might just help you stay a little bit more open-minded, even though obviously it's not a perfect science. I wanted to really get to Sklarew's comments on his oscillator techniques. Much of his book is spent on numerous little tricks at looking at charts, measured moves, you know, interesting, funky little rule of thumb techniques he has, and I'll let you explore those for yourself if you want. But I thought that his oscillator techniques were particularly fascinating because he did them in the 70s, actually the 60s and the 70s, before we had computers. And so he originally came up with some rules for a very simple net change, which is a one-period rate of change, simply the difference between today and the previous day. And what he would do was he would draw trend lines on the oscillator in the direction of the price chart, and then when that trend line was penetrated, he would use it as an early warning signal and take that as his cue to then draw the trend line on the bar chart. And I'll show you exactly what we're going to look at. Additionally, he could draw very long-term trend lines across the tops of longer-term oscillators and look for the penetration of these to be new momentum highs or lows, indicating a change in the supply-demand imbalance. All right, so hopefully if I show you some of these, you will look at your own oscillators or charts with a slightly different eye. I just stripped away everything else on this daily bar chart here. No fancy colors or moving averages or anything. And what I did is at the bottom, we plotted a one-period rate of change. I'm not suggesting that you use this yourself, although you might want to play around with it, because what we're going to do is we're going to take the concept from this and then update it with something that's a little bit more durable and less noisy. But still, if you want to play around with this stuff, the whole idea is that it draws you in to study the charts for yourself in greater detail. And then it's almost like osmosis. When I come in the morning to trade and I've done my work the night before, looking at all my little two-period rate of change work, it's like I know that market by the back of my hand. And so if it does start to kick in as a buy day, low to high day, you know, or vice versa, I feel like I'm right on top of it. So again, what I want you to notice here, I'll just take this middle example of this upsloping trend line. And again, he said, it needs to be drawn in the direction of the price trend. So if the price is rallying and trending up, we draw our line underneath that series of lows. And the first penetration of that line is not a sell signal or a buy signal. It's a warning signal that then you can start to draw the trend line across the price, because it does tend to continue for a couple more bars. And I'll let you play around with this. You can see here in the middle in October, we had a break of the trend line to the upside, first little sign of impulse, and then we sold off for 2 or 3 more days before making a shallow 2-week reaction to the upside. So let's look at this in some more detail. Now I have his 1 period rate of change on here, as he called his net change oscillator. And interestingly enough, he also used a 5 period rate of change. Really interesting for somebody doing this in the 70s when they had to calculate it all out by hand. And he said that this 5 period rate of change was not so great for signaling turning points, but as a trend progressed, the swings would get shallower and tighter. And he would draw converging trend lines around that and look for the trend to end when it's close to the apex. So this is a chart of gold. First, if we look at the middle panel where I've got this first green slash, you can see that was the bar that penetrated that down sloping trend line, because the market was in a little corrective A, B, C consolidation. And you can see that green trend line didn't break the price trend line. It was just telling us that that was the point at which we needed to draw a breakout line for above the highs there, which was officially the trigger of that upswing. All right. And conversely, at the top, you can see if we drew the trend line down across the bottom of these, where that red slash is was a new break of that trend line. We hadn't broken any price trend line in the oscillator. It could have still rallied up, but it was like an early warning. So that's something that's really easy for you to keep an eye on and you can try it with a 1 period rate of change, but then I'm going to show you what I use, which is a 2 period rate of change. Just one more example here for you, the NASDAQ, and you can see how it unfolded at the bottom when our downtrend was broken in December. There was no trend line you could have drawn across that waterfall at the time, but it definitely gave a change of supply demand there at the time. Now, we didn't know for sure that was going to just be a short squeeze. All right. It doesn't guarantee that you're going to get a trend, but then you could draw the trend line across that high that unfolded a couple days ago. And then, of course, we launched off to the markets, to the races. Now, just for kicks, I thought, well, let's see where we are now. And you can see that this 5 period rate of change at the bottom, you can draw converging trend lines. I'm not quite sure where that apex is going to fall or how it's going to come into play. This isn't something that I normally use in my own trading, mind you. But it sure is fun to start looking at some of these things and see how they play out. So we're going to keep an eye on that one over the next couple trading days or a week or two. One last thing that he used was, in conjunction with his 5 period rate of change, he used a 5 period simple moving average, which I thought was so freaking cool, because we've done so much modeling and testing on the extended runs or the persistency of trend when you get consecutive closes on one side of this 5 SMA. And I hope you stay with me here, because you are going to see how this all ties in together in the grand finale at the 5 minutes at the end. You know, it's kind of sad. You do this work and this research and you think you've come up with a novel idea, and then you discover that this guy was doing all of it 40 years before you. You're like, ah. Just as a note or an aside, like I said, he didn't find a whole lot of use in this 5 period rate of change in terms of forecasting short-term turns. The thing I wanted to note for you guys is look how much the price does chop through the moving average, this 5-period moving average on this particular chart, before then having another extended run to the upside. So my point is, none of these are perfect indicators. They all go through periods of noise. And it was really cool for me to read between the lines in his book again. And he made many references to the times that these things weren't of great value, but he was always on the lookout for his particular indications that they were. And lastly, he commented about drawing trend lines, and this is actually something that I do indirectly across the tops and bottoms of longer term oscillators. This is a 310 oscillator, and I'm sure most of you are familiar. If you've seen my work before, I use it. And this is how weird the universe is. This is synchronicity. Perry Kaufman emailed me today because he was doing yet the 8th updated edition of his a magnificent book, which everybody should have a copy of in their library. And he was updating something called the first cross buy or the first cross sell that I gave a kitschy name to many years ago with this 310 oscillator. And it's not going to show up necessarily on this particular chart the way it was meant to, but I noticed with Sklarews' work that when you had that first penetration of the trend line, that next pullback, you can see my mouse right here on the far right-hand side of the side, that would have been a first cross buy type of rhythm. And then down here, I've got the 3-period, the 310 oscillator and the 5-period moving average oscillator, net change oscillator. And you just get the basic idea that you can draw trend lines across the oscillators as well as the price. And it's not like we're necessarily trying to capture the breakout from these trend lines, but the main point is when you do get a break of these trend lines or these points, 80% of the time, at least, you get that ABC rhythm. You see? So right here in the middle of the chart, where we broke the trend line to the downside, and it doesn't matter if you were drawing it on this 5-period rate of change, or you could even draw it across the 310 oscillator. We got that first nasty break to the downside there, and then you can see this slash of 2 lines here in December, which was the first cross sell. And that gave you your ABC down. So if you have the patience to follow the structure, that middle part of that zigzag wave is a very identifiable point that you can make a trade on. Okay, so now I'm just going to jump ahead a little bit. I assume you're all taking notes and can come back to this and furiously study it. I do this actually with the 2-period rate of change. And we're going to start off here just by looking at the times that you do get a break. Okay, I'm not talking about entry triggers. We're just talking more about the world of analysis. When you do get a break of that low, we actually do get a quasi ABC type of thing, down or up. And of course, it can be much more than that. All right. And this is sort of how I make my living, saying, okay, break to the upside, pull back. Obviously, it's not just an ABC. It's a much greater trend there. But just think about everything in the context. We broke the trend line here to the downside, and I'm going to look for the next short sell on this 2-period rate of change, even though the market didn't give us much. That's not the point. It's staying in the rhythm, and sometimes you get a lot, and sometimes you don't get much of anything. I'm not here to predict what the market gives. I'm just showing you how you can start to see that rhythm with getting that second pulse of that ABC down with these simple little breaks. And mind you, I haven't even come to the coup de grace yet. Now, I mentioned the fact that I wrote this book, Trading Sardines, and this was one of the models that I first used to model volatility back in the late 80s and early 1990s. And this is actually a chart from the book. And what I used to do was to overrate multiple rates of change. So here I've got a 3, a 4, a 5, a 6, a 7 period rate of change, all piled up on top of each other. And I used to be a serious OEX option trader. So when these would cluster tight together like that, I would buy straddles. And then when the bands expanded, I would short straddles. And that was the first of my buy volatility, short volatility trading models in the options. And it's an interesting concept because I didn't understand what it really was doing until a later point in time. And that is what I'm going to show you next. Oh, and I have to shamelessly promote my book here. That's a picture of it, what it looks like. If you want it, it's on my website. You can go and you can read the first chapter of it and see the table of contents and so forth. You're not going to find it on Amazon, so I have to hype it on my website. Okay, so this is current market conditions now, basically looking at the Russell from quite a number of months ago. And you can see the points where we cluster in these tight price bar charts, and also the difference between the max min of these rates of change. So you see how that is? And the lesson from this is that some of the best trends in the market come from equilibrium levels, not from overbought or oversold markets. So some of our very best trends can come from these equilibrium points. And for those of you that are more familiar with modern auction theory and market profile and volume distributions, where the market has reached agreement and we have the highest volume distributions, that's another way of saying that you've got an equilibrium level. And so sometimes they look like they're points of triangles, and other times they look like classic momentum divergences. So you can see here that we've got the classic point of a triangle on the Russell back in May, but at the top in mid-June, if I had my 310 oscillator, this would be a textbook sell divergence because it happens to be about 10 to 12 bars apart. And so these are the two main spots that I look for to put on a position of a holding period of anywhere from 4 to 5 days. If it wants to go further than that, wonderful. But when I was trading the options, I'm pretty much looking for a holding period of 4 to 5 days, and then I take it off. And just so that you know, this concept works on every single market. I only use it on the daily charts, but you would be able to see this on intraday data as well. So this was actually Nat Gas when it made a top up here on this test. And you can see what's happened to all the assorted momentum functions. And same thing here at this point. And I've got a funny story in the book about how I originally programmed a neural network off of these momentum functions in the first and second derivatives. And this was back in 1992. And it was a pretty kick-ass experiment. And I'm just going to have to let you read about that if you choose. Okay, just two more points here. Unleaded gasoline has been one of the more dynamic markets on the board, but look at this long basing period that it had. And when we finally came out from the upside here, it was once again from an equilibrium level. So now I'm going to show you one more little trick that we've done. I simply took the max min between these different rates of change here. It's not so difficult. You can do it with TradeStation or CQG, probably Ninja, probably any of them. Take the max min and then run an RSI on it so it normalizes it. That's a lovely trick, running an RSI on something to normalize it or give it an absolute reading. So now we can scan for these things and have them pop up, and then you can start monitoring them for a few days until you know that they're ripe. And I just happened to see this current one today. The Canadian dollar had a superior trend day up today, and you can just see the equilibrium level that this has been forming. Of course, it's pretty easy to see on the bar chart as well in this particular case. Sometimes it's like that. Sometimes you can see it just as well on the chart. Okay, so I'm just going to mention a little chart formation that I found in Sklarew's book when he was looking at measured moves. And this is fun because it works on 5-minute data, hourly data, daily data. And actually, I wish I could claim credit for this title, Cross Through the Box. That was originally used by Bob Uran when I met him back in 1991-92. And there's a story in the book about when I traded his volatility breakout system and all that I learned from that. And so he talked to this cross through the box concept of when he would double dip off the volatility breakout system. And it's a kitschy little thing, but I think you'll see that it's quite visually appealing, and I'm going to show you a way to put it in a context of classic auction theory. So this is a big daily chart of copper, and we break below that previous swing low. So I've got my big rectangle here, and obviously in hindsight this is effectively a bear trap. Okay, so we've pushed to new lows and came back up very quickly. That's a classic Wyckoff Springer upthrust comment, or a bear trap or bull trap. So here's the play. If we make a push back into the box pretty quickly, or back into your trading range, the first thing we're going to look for is a trade back to the middle of the range, which is your high volume node, or your point of control, or your equilibrium point, whatever you want to call it. I call it home. So we pushed back to home, and we don't always take out home. Sometimes home can be resistance. But if we do take out home, then I'm going to look for a push above that range of an equal duration that we took out the downside. And you will be stunned at how many times this works almost perfectly. So you can see here, we broke below by this amount here, and we pushed above by this amount here. And now copper is looking a little bit perky. We'll see if it can do anything more here in the next day or two. But that was a good example on that one. Here is a 30-year yield chart. So what you're looking at is the inverse chart of the bonds. And you can see that we pushed above the upside here by just a little bit. And we came back and traded around this big central value node. This was the value at that time, all right? So it doesn't include this data over here. But you can see how these points are just magnets for us to twirl around. And of course, when it didn't hold it, it broke through by not just an equal amount, but much more. So not a hard or fast rule about how far it's going to go, but I know it's going to go at least by the amount that it penetrated prior. And here it was on a 5-minute chart. This just happened last week. I'm like, oh my gosh, this is so cute. This was a pit session data. All right, so you can see we had a morning rally above that early AM high. Okay, this is all central time here if you look at the bottom time scale. And we pushed outside by that amount. And so when we came back down to the middle of this, to the opening price, just for kicks at that time, I actually looked at this orange line and I'm like, oh, you know, there could be a play here to go down and fill to that orange line. We actually went through it a bit, okay? But I just thought that was like a cool little example on the 5-minute chart. So it's really a spatial relationship. Okay, now let's start tying some of this stuff in together more. I've mentioned the momentum can serve as a change in the impulse, the supply-demand factor, and in this particular case now, we're going to use it as a trigger. And we really modeled these extended runs in 5 zillion ways up and down on every single type of market, because everybody wants to catch that trend that you can just put on a position and not have to do so much work. I mean, usually I'm having to do more work every single night because that's the nature of my trading, one data point at a time. But once in a while, we get these really cool setups, and I'm going to show you exactly what they are and how to capture them. It's nothing more than looking back at the new 30-day high in a 2-period rate of change. Okay, so we have a little program on our trade station, a scanner. It does this on stocks and futures. And it'll trigger when this thing makes a new 30-day high or a new 30-day low. Now, here is the catch. There's always a catch, because of course it's not that simple, right? Otherwise, we'd all be sitting on a beach drinking coconut drinks. But it has to be put in context. So anytime you use momentum functions, it has to be confirmed by price. And at the very end of this, I'm going to show you a kitschy indicator how to reverse that to your advantage. Right now, we're just looking at momentum highs and price highs, and you can see how at the bottom here, I've got a histogram that's the difference between a 1 and 5 period simple moving average. So you can see if this has 7 bars above 0, it's got 7 closes above the 5 SMA. Every market out there in the futures has at least 9 to 10 of these 5 SMA runs per year. Every single futures market has had at least 27 closes on one side of the 5 SMA at one point or another. So that goes back to the old adage. It's never too high to buy. It's never too low to sell. And I've done lots of YouTube videos out there on this 5 SMA work that you can go research for yourself. It wasn't the main point of today's presentation. But just notice you have the price high and the momentum high. Now, look back here at these 2 blue lines. These were also periods where we made new momentum lows on the 2-period rate of change, but we are not making new price lows. We're just having a reaction down in an uptrending channel. So later we're going to configure an indicator based off that, you see, for the failed indicator. But for now, I just want you to start to realize how important these launches are. Here was another one in the NASDAQ futures at the beginning of the year where we made new 30-day highs on the 2-period rate of change. Of course, it wasn't the low, but that's not the point. It would have been a spot where you could put on a trade and hold it for a couple days. Very important. Now look at this low here with the blue slash line and the second one. Same thing again. You're still in an uptrending channel. You're still making higher highs and higher lows. It's just a good flush down. You haven't done any distribution type of top. So again, we're going to come back to that. But I just want you to get so jazzed and excited about seeing these initial triggers here, and then it's up to you to put them in context, and the context has to be a supportive daily and weekly structure. And I'm going to show you what is not a supportive context too. So you need to go and do the work and see when does this work and when does it not work, because that's how you make something your own. So here we had our initial blast off in the hogs. And of course, they slaughtered 1 million overseas, so that's not any new news. But the market's acting quite well because it made another new momentum high and yet another new momentum high. And then at the top of this swing, almost every extended run, you'll find one of 2 patterns. You'll either find a balance pattern where you start to get price bar overlap, or a 3-bar triangle, or there's lots of terminology for this in market profile terminology, or you will get a wide range reversal where you have a very big spike up and a sharp spike down, like a V spike bottom or a V spike top. And here we just gave a little 3-bar balance area before correcting back down to that 20 period EMA. And even though this oscillator made a big flush down there, context, 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 it was not a breakout from a base or a breakdown from a top. It was a pullback in a trend. And just recently, this was from last week, the DAX gave an explosive buy, and it's still making higher highs to this day. So that was an indicator that gave us a lot of confidence that the stock market still had plenty of upside, looking at these world index ETFs and so forth. Now, just to show you a few stock examples, because I don't like to trade stocks, for short time frames. They're just too noisy. I'd rather trade the futures with the leverage. But look how nicely this does work on stocks, because with the stocks, not only can we get the 2-period rate of change new momentum highs, but we can also get the breakaway gaps or the range expansion. You see? So I'll just scroll through a couple of these to whet your appetite. This was actually on gold, the Spider Trust, that you can see right here to the far left, where we made that new 30-day high. It wasn't great range expansion per se, because this particular product doesn't really trade quite like that. But you can see we did have the gaps, the unfilled gaps, and then later our extended runs. And that's really for a proxy for the gold market, because the gold actually did the same thing beautifully. Okay, here, Home Depot, range expansion, breakaway gap, new momentum highs. Now, until you do the work for yourself, you're not going to really understand the power of the trends that you can get out of these types of fig signals. And it's kind of a shame just to buy and hold for 2 to 3 days and then get out. So I really like this type of work for position trades. And at the same time that the market was rallying during the month of February and into March, you can see that we also had downside plays. This was US Steel, and we had the range expansion to the downside after we had done distribution. See, you had the balance area here, 7 days or 6 days of price bar overlap. So that's really significant when you get that structure. And if you looked at the weekly charts, the weeklies had a great bear flag. So putting it in the context of the dailies and the weekly charts, looking for the range expansion down. And the beauty of this is that you don't have to catch it that very first day. It has forecasting value in that momentum precedes price. And you can see that we sold off for another 6 days here. And same thing here. I put this example in just a week or two ago, because the market, there were so many stocks that were doing really great. We were having great upside breakouts in tech stocks and so forth. And this was actually around the FOMC time. But you can see here, I was like, oh, wow, these banks are really signaling something unusual. And this was USB at the time. And we continued to sell off another 2 handles down. And 5 more days down, so it wasn't too late to trade this to the short side, or even look for more downside. And the real faux pas would be thinking that it was a pullback to buy. So we don't want to do that. NVIDIA, we caught this right as it was happening. And it wasn't quite new price highs, but you could see overall the structure was there, and we had such superior trend on that day's bar. Now, NVIDIA is 191, all right? This was when it was like 160. We actually played this with options at the time, but they expired last week. So you can study these charts for yourself. That's all I'm going to say. And I could flash lots of examples there to whet your appetite. Now, lastly, remember how I said that sometimes a failed signal can have power for something in the opposite direction. So this was a kitschy little gimmick that I called rock dots, which was for dots from the 2-period rate of change highs or lows. And you can see these green arrows here actually are when the 2-period rate of change made the new 30-bar lows, but we were still in an uptrend. And there's lots of different ways that you can define an uptrend, and with various degrees. Now, normally with this particular signal, I'm only looking of a duration of 1 or 2 days, although it can lead to something more. But what I did was I used a CCI. This was a trick shared to me by a friend, my trading friend in Houston, that we've been buddies for almost 2 decades now. He's also in my book. And simply when this CCI, which I believe is a 60 period, there's no right or wrong parameters. Play with this stuff for yourself. When it's still above a certain threshold, but you get those new momentum lows. Okay, so you can see here, you didn't get much to the upside, but here we had a great short sale on the crude, 1, 2, 3, 4 signals before then we formed that divergence and really started coming out the upside. So I'm showing this to you on a daily chart. You don't normally get many daily signals, like maybe 1 a quarter usually, but it works great on intraday charts. So I'm saying that as a tease to show you what's to come. And you can see here first on the QQQs how this 2-period rate of change made new momentum highs. Now, it wasn't a breakaway from a base. Overall, we were in a downtrending environment, and you had a little short sale play there somewhere the next day. It wasn't great. All right, and same thing here, coming off this bottom, I have a signal. It was a little short sale. It wasn't great. This buy was superior back here on the right, and we had another buy. But I just wanted you to see how this was constructed first. Because when I'm trading and I have a short-term chart up, like a 5 or a 15-minute or a 30-minute, trust me, I do not have a 2-period rate of change on it. All right, so I wanted to show you how it was constructed with the daily data, and then I'll show you what actually looks like on my intraday. So this was Nat Gas. This is actually CQG's software here, and it plots these little arrows automatically. And you can see it's just highlighting sort of the ABC consolidation that we had in an uptrending market. Again, I wouldn't have any of this stuff at the bottom of my chart, but I can get alerts that pop up. And then this is actually what it looks like on TradeStation. And I just picked some assorted markets and time frames. And this is what it'll look like, a little dot popping up. Now, before you think it's the Holy Grail, let me tell you, it takes a long time to study when this works and when it doesn't work. So with any momentum function, be it an RSI function or an oscillator function or a 310 or a stochastic, you must be very careful of any buy that happens after a sell divergence, because more typically after you get a divergence, the first buy will tend to be bad and you'll do more of an ABC consolidation unless it's an extremely strong trend. So it's not going to work great after a divergence. Obviously, if you've had an extended uptrend and it's the 5th flag at the top, you have to pull in your horns. So all the classic little traditional rules about when this is going to work and when it doesn't work, you need to be mindful of, all right? Because you will get false signals as well. But it's just something fun, you know, it's something fun during the trading day. We use it just during the morning session. I don't even look at this stuff after Europe closes. And, you know, it's just sort of to amuse ourselves. So lastly, let me just show where really some of the better stuff for me comes into play. And that is with my traditional 2-period rate of change and looking to buy when you've actually had 1 or 2 days high to low, vice versa, and looking for the flips up in the direction of the trend. So the slow line, pink line here on the right side has an uptrend to it. I'm going to look for the spots where I've got a pullback in price or the 2-period rate of change, and then see what the market gives me. So really, I don't get a whole lot more complicated than that. Just some basic pattern recognition. And same thing here. This is in the boons, which not as great of a market as they used to be for now. They will come back to life, but same idea, buying the pullbacks, the down 1-2, and looking to hold it for a day or two, as well as the breaks. And this is all based here on A, is this slow line above 0? Or B, does it have a slope that I can trade against? So I know that many of you have seen work that I've done with that 2-period rate of change and pattern recognition. And lastly, the pinball buy was something that I showed in that Street Smarts book many, many years ago. But when we did our initial testing, we were not using any filter. So what the pinball is simply a 3-period RSI of a 1-period rate of change. And the key is, don't take buys unless the price is above that 20-period EMA. This was not in our original research. And don't take the sells if the price is above it. All right? So very simple filter. You can see at the bottom, I plotted a 3-period RSI of a 1-period rate of change, and that's what it looks like. And right here on the yen. So these little dots are something different. Ignore those for now. They're just simply when the slope of all the lines are in the same direction. I call them P of 3s. But I just want you to look at these areas that I've got circled here on the highs, where it simply said to me, the next day, look for a shorting opportunity or for the market to go from high to low. So that's really all I try to do, is get the main idea right. Can the market go from low to high for the day or from high to low for the day? And then lastly, when I do this, it's still a process of one data point at a time. So I don't know what the market's going to give me. Back to Sklarew, we can't forecast how high a market's going to go or how long it's going to go for. All right, but we can process our analysis and our trading one data point at a time. It's a very Bayesian type of approach to updating our models with new information as it comes in. So you can see I've got here the rock dot little cells where those arrows are. All right, and down here I've got the pinball buy on the right side, and here I've got the range expansion and the new 30-day highs. I'm sorry the scaling of this chart is squished as weird as it is, but my main point is that every day I look for the next day and say, is there a setup? Is there a trade condition? How am I going to trade today coming in? And so right here we had 2 days of consolidation, highs to lows that couldn't even push that market below that 5 SMA. And by the way, that was the condition that we came in with this morning. Strong uptrending market, obviously. And we've had 7 closes above the 5 SMA at the end of last week, meaning that potential for an extended run. And when we have that, we know that morning weakness is a buy. And what was the 5 SMA reading coming in on the S&Ps this morning? 84. Okay, and we made, so it's a good reference point to look at. The NASDAQ just poked below it. The Dow obviously was biased with Boeing. The small cap indices didn't quite get there. But I just thought it's so cool that somebody had done very similar type of work one day at a time with his net change oscillator, Arthur Sklarew, years ago, 40 to 50 years ago, before we had the advent of computers. And he was plotting all of this by hand. And that's what made him so exceptional, was putting in the time day after day for his commodity charts. And I sent an email to Stanley Dash making him promise to tell me more stories about this amazing gentleman, because what's happened is, in our age of digital technology and expedient information, the culture of the markets is getting lost, and all the wealth of information that was contributed by people that were technicians and traders in the 50s, in the 60s, in the 70s, and in the 80s. And that was another thing I hoped to capture when I wrote my book, was some of all the lessons that I learned from people like Ned Davis and Hank Pruden and Mike Epstein, who was like my surrogate father, and just through all the years, because as these people move on, we're losing a little bit of the culture that goes with it. So I encourage you all to buy some of these old books. And when you go on Amazon, you can find used copies. I buy used copies of books for like $5, because I'm going to mark them up, with my pen and yellow highlighters and stuff like that. And every single one serves as an inspiration to me, to keep on burying myself in the charts and looking for fun. So I hope that you all enjoyed that and were able to take something with you to trade, to try for yourself. My email, if you want to contact me with any questions, you can do that on my website, lindaraschke.net. And I may not get to it the next day, but it's been so much fun all the years sharing things with you guys. And somebody always emails me back and says, "Oh, I read this gem," or "I tried this," or "Did you ever look at that?" Or like today, Stan Dash contacting me. I sat next to him for 10 years, while he was writing his book. I'm like, I almost, to me, that just made my day. So a little tidbit of information there. So lindaraschke.net. And again, if you want to read the first chapter of my book to get an idea what it's about. And I thank you all so much for showing up this evening. I know it's dinner time in some parts of the woods there, but I really appreciate it. And I'm not sure how we do questions here, or if we even have time for them. Is our moderator on?
Hi, yes, I am.
So
I think we have time to take one quick question.
Okay. Well, you're going to have to read it off to me, because I can't see anything.
I will. So we have a question from AJ Skent, who says, in your book, Street Smarts, do these strategies still work on the stock market 23 years later?
That's a great question, because the principles are still there. Of course, there's little subtle tweaks of things that don't work. For example, I talked about, ticks being overbought or oversold at certain levels. And back in those days, ticks had much more of a powerful play, because stocks were traded in eighths. So it was much more meaningful if you had half the stock universe uptick an eighth that could bounce an index, a couple points. But the whole idea behind the Street Smart book is that you're basically looking for a breakout pattern or a mean reversion pattern, okay? Or a case that it's a continuation pattern. I mean, really, it just comes down to those three simple concepts: breakouts, mean reversion, or continuation, which is usually a function of new momentum or a trend channel, something along those lines. And then the real trick is, how do you circumvent the noise level that is in the markets now? So it's not so easy or black and white to model this and back test it, because obviously if you could do that, everybody would be a millionaire sitting on a beach running little trade station strategies, right? Or else they'd be making billions of dollars with a hedge fund, selling their little short-term strategic algos to them. Okay, so mechanical systems, I've yet to find one that I would trade mechanically. It's not so easy. You can model things for initial conditions, you can model things for triggers. I don't have a lot of confidence that somebody's going to sell a mechanical system and make money, or buy one. Although you can see all the work in the modeling that stands true, but all these things that I showed you, they're durable and robust. For example, the turtle soup concepts in the Street Smarts book. That's the play around the swing highs and the swing lows. It's not necessarily meant to be a mechanical system. There's fabulous opportunity in making counter trend trades at these points because there's an increase in volume and it'll either break out and run, or it can be a little mini trap. Now that trap might just last a day or two, or it could be a more significant swing of 2 weeks in the opposite direction. But that backs up my point about you still have to take 1 or 2 days at a time there and then see how the market reacts to that. So absolutely, you know, the street smart stuff, the pinball stuff, I trade that every day when I get a good setup.
Well, thank you so much, Linda. This has been such a pleasure, and we so appreciate you sharing with us again.
You're welcome, and have a fabulous week. It looks like you've got tons of interesting ideas out there to be presented.
Thank you. We're looking forward to it. Have a great night, Linda.
I think I'm going to stay on and hear the next speaker.
Fantastic.
I encourage everybody else to as well.
So coming up, we have Hema ready. But before we get to Hema's speech, I would like to go ahead and ask you to take a look at our review option. So we have a feedback option that I believe that Marissa has mentioned a couple times today. If you go to Wealth 365,